ZIM just went absolutely vertical, up more than 30% in a single day. And if you're wondering why your shipping stock suddenly turned into a rocket, this is the story you need to hear. Because this wasn't earnings, this wasn't a dividend, this was a full-on buyout. And when buyouts happen, the market reprices a stock instantly. Here's what went down. For months, ZIM was being ignored. Shipping rates cooled. The pandemic boom was over. Dividends got smaller. Most retail traders moved on to AI and mega caps. But smart money was watching something else. Rumors started floating that Hapag-Lloyd, one of the biggest container shipping companies on the planet, was looking at ZIM. At first, nobody believed it. Then analysts started talking. Then the stock started quietly climbing. And today, it became official. Hapag-Lloyd agreed to buy ZIM Integrated Shipping Services in an all-cash deal for $35 per share. Now pay attention to this. ZIM closed last week around $22. So this deal came in with a massive premium. That's why the stock didn't just go up, it exploded. This surprised Wall Street, because when a company offers cash for your shares at a much higher price, the market has to immediately move the stock closer to that number. That's called deal pricing. But here's the key, the stock didn't go straight to 35. And that's where things get interesting, because when a buyout is announced, traders start playing something called merger arbitrage. Funds buy the stock below the deal price and try to capture the spread between where it trades now and where the cash payout will be. But there's risk. The deal still needs regulatory approval, shareholder approval, and in this case, even government approval. So the market prices in the probability of the deal actually closing. That's why you got a huge spike, but not all the way to the buyout price. Here's what could happen next. If the deal moves smoothly through approvals, the stock will likely grind slowly toward $35. If there are delays, the stock could move sideways for months. If the deal somehow falls apart, the stock could drop back toward its old levels. So this is no longer a normal shipping stock trade. This is now a deal trade. Your upside is capped. Your risk is the deal breaking. That's a completely different mindset. Now let's zoom out, because the bigger story matters. Shipping is consolidating. Bigger players want bigger fleets, more routes, and more pricing power. By buying ZIM, Hapag-Lloyd becomes one of the largest container shipping companies in the world. And ZIM isn't a weak company. It has modern LNG-powered ships, strong margins, digital logistics tools, and a profitable Trans-Pacific network. This wasn't a bailout. This was a strategic acquisition. That's why the premium was so big. Now, here's something most retail investors are missing. Long-term ZIM holders already made a ton of money from dividends over the past few years. This buyout is basically a final cash exit on top of that. That's rare in a cyclical industry. So, if you were holding before the news, you just got paid twice. Once from dividends, and once from the takeover premium. Now, the big retail question is simple. Do you buy now and try to capture the remaining spread to the deal price? Or do you take profits after the spike and look for the next takeover target? Because Wall Street is already scanning the shipping sector for who might be next, and that's where the real opportunity could be. One more thing, and this matters. This move shows how powerful M&A headlines are. A stock that was boring yesterday can become the biggest mover in the market overnight. No earnings required, just one announcement. So don't just watch charts, watch corporate actions, because that's where these explosive moves come from. Now I want to know what you're doing. Are you holding ZIM for the buyout spread, or are you locking in profits after the 30% spike? Drop your strategy in the comments. And if you want more fast-moving trade setups like this, hit subscribe, because the next takeover move will not wait for retail.